Hey everyone, and welcome to This Explainer. Today we're unpacking a massive financial paradox surrounding a company called Silicon Laboratories, or SLAB for short. If you look at the raw data for this company, it tells a truly wild story. As investors, we're constantly trying to make sense of the market. But every now and then, a company comes along that completely shatters traditional expectations. SLAB is exactly that kind of company. We're going to build a comprehensive picture of what's going on under the hood by looking strictly at their numbers. And I promise you, the deeper we go, the more intriguing this puzzle gets.
Okay, let's kick things off with a massive, eye-catching number. If you're holding SLAB right now, you are probably absolutely thrilled because their trailing 12-month total return is an incredible 131.99%. Just let that sink in for a second. In a single year, the total return has more than doubled the investment value. When you see a metric like that, your initial instinct is that this company must be firing on absolutely all cylinders, right? Raking in cash hand over fist.
But wait, contrast that right away with this jarring reality. Their trailing 12-month net income is a loss of almost $65 million, actually negative $64.9 million to be exact. What's really fascinating here is the sheer scale of the disconnect. Wall Street is famous for forward-looking optimism, sure, but rewarding a company with triple-digit returns while it actively bleeds $65 million, that is a paradox that absolutely demands our attention. How on earth is Wall Street justifying a company losing this much money?
So how do we solve this mystery? We're going to break this down into 4 quick chapters. 1. Skyrocketing price performance. 2. The profitability problem. 3. A bulletproof balance sheet. And 4. Valuing the contradiction.
Chapter 1. Skyrocketing price performance, the green lights. Let's zoom in on that skyrocketing stock price to see exactly how much green investors are currently seeing. Looking at their historical yearly returns, you can immediately spot a completely brutal 2022, where they dropped over 34%. For a lot of folks, a drawdown like that is immediate panic-selling territory. But look at the incredible resilience on the other side of that dip. We're seeing an aggressive 66.57% year-to-date bounce back so far in 2026 alone. This isn't just a slow recovery. This is a massive V-shaped snapback. To put that rally into today's context, as of May 2026, the stock is trading at $217.70. That is literally pennies away from its 52-week high. If you had the foresight or, honestly, the luck, to buy at the low just last year, you'd be sitting on a gain of over 115%. It's riding a wave of incredibly powerful momentum. But momentum is essentially a popularity contest. To understand the actual business, we've got to look under the hood.
Chapter 2. The profitability problem. The red flags.
When we look at the actual earnings, the engine sounds like it's completely falling apart. They make a totally solid 55.8% gross margin on their actual products. That's great. It tells us that whatever they're creating, the market values it. But then the rest of the business gets in the way. Their operational costs completely cannibalize those gross profits, dragging the net profit margin down to a dismal negative 14.97%. So they aren't struggling to sell products at a good price, they're just struggling to translate those sales into actual bottom-line profit.
And man, this inefficiency bleeds across their entire operation. We're seeing deeply negative returns across the board. Return on assets at negative 5.20, return on equity at negative 5.93, and return on invested capital at negative 9.10%. Basically, for every single dollar of capital or assets they use, they're generating a negative return. By standard accounting metrics, it's an incredibly inefficient use of resources.
Now, before we see how the market prices this mess, let's just do a quick refresher on EV to EBITDA. It's a crucial valuation metric comparing total enterprise value to core operational earnings before interest, taxes, depreciation, and amortization. Basically, it strips away the accounting noise to show us raw operational value.
While SLAB's EV to EBITDA is an eye-opening negative 207.12, combine that with a heavily negative PE ratio of almost 110, and traditional earnings multiples just completely break down here. You literally cannot value this company using traditional models because there is zero positive earnings to base the multiple on. Usually, a profile like this sends investors running for the hills, so the big question is, why aren't they? Why is the stock up over 130%?
That brings us to Chapter 3, a bulletproof balance sheet, the safety net.
The answer starts right here, 0. SLAB carries exactly 0 debt compared to its equity. In an environment where interest rates can fluctuate and debt servicing can totally crush an unprofitable company, having 0 debt is like having an impenetrable shield. It completely eliminates the risk of bankruptcy from defaulting on creditors. They own what they have outright.
Plus, they are just swimming in short-term liquidity.
Their current ratio is 4.69, and their quick ratio is an incredibly healthy 4.02. This means they are holding enough highly liquid assets to cover their current liabilities more than 4 times over. Even though they are losing money on paper, they've got plenty of actual, immediate resources to keep the lights on without breaking a sweat.
Throw in a 0% tax rate over the last 5 years, and you have an absolute financial fortress. When a company has absolutely no debt obligations and no tax drag pulling cash out of the business, it gives investors incredible peace of mind. It allows the market to just look past the current negative net income and focus entirely on the future.
Which leads us to our final chapter, valuing the contradiction, future over present. So how do we actually value a company with a bulletproof balance sheet but terrible current earnings? Well, to see what Wall Street sees, we have to drop the paper earnings and look at cold hard cash. Enter the price to free cash flow ratio. This metric compares market value to the physical cash the business generates, entirely filtering out paper accounting anomalies that don't actually drain the bank account. Cash is reality.
SLAB's price to free cash flow ratio is an extremely high 108.93. To put that in perspective, investors are paying nearly 109 times the cash the company currently generates just to own a piece of it. That is a hefty premium. It tells us the market isn't just ignoring the negative earnings, they're actively throwing money at the underlying cash generation, fully anticipating it's going to explode in the future.
And here is exactly why they're willing to pay up. While net income was a negative $64.9 million, their trailing 12-month free cash flow was actually a positive $65.78 million. And get this growth trajectory. Free cash flow grew by an astronomical 345% over the trailing 12 months, alongside almost 34% revenue growth. They are generating real compounding cash at a rapid rate that completely masks the accounting losses.
So, that leaves us with this massive question. To wrap up our explainer, is Wall Street absolutely brilliant here, pricing in a cash-fueled growth miracle built on a debt-free fortress of a balance sheet? Or are they completely ignoring a giant mountain of operational red flags and negative earnings? When a stock is up over 130%, but traditional earnings are entirely absent, you really got to ask yourself, are you buying the cash flow of the future or just the hype of today?